Welcome back, folks, to Investor Diaries. Today, we'll talk about a new instrument in the market called CDRs. CDRs stand for Canadian Depository Receipts. Now, what is this instrument? What do they do? How will they help? We'll talk all about it today in this video.
All right, so what are CDRs? CDRs are modeled after ADRs, and ADR stands for American Depository Receipts. And what it does is that it allows investors to invest in some of the most famous companies worldwide.
So, ADR or American Depository Receipts, as Abhi mentioned, were very common in the US for companies from other countries to raise capital in the US. For example, an Indian company would have an ADR in the US so as to raise money or allow the US investors to invest in that particular company. Similarly, Chinese companies, and recently we've seen a spate of them, for example, Didi, Alibaba, etc., launching ADRs in the US, allowing US retail investors to invest in them. So the CDRs, or depository receipts, hadn't been issued in Canada because the conventional use case that applied to ADRs wasn't applicable in Canada.
Yeah, so Nitish, I think here in Canada, we are easily able to buy equities in the US. And more importantly, we also share the same time zones. So that makes it kind of easy. But at the same point of time, we've had to pay FX fees on that. And now with stock prices increasing, I think that over the past few years, it's increasingly become a challenge for Canadians to invest in the high flying US stocks.
Yeah, and that exactly is right. So the conventional use case was not applicable, but then there are two new use cases, which is hedging the FX rates or currency hedges and the ability to offer fractional trading, right?
So Nitish, from an investor standpoint, is there any difference? Because this is listed on Neo Exchange and a lot of the famous Canadian companies are listed on TSX.
Yeah, that's a good point. There's actually no difference between buying a stock in a new exchange or buying a stock in TSX. It's the exact same process. The only caveat here is making sure your brokerage supports this exchange. For example, Wealthsimple does not support new exchange. So if you're on a Wealthsimple platform, you may not be able to buy these CDRs. But for the majority, most of the brokerages, like even Questrade or the big banks, they support this new exchange, and you can buy stocks on the exchange.
So Wealthsimple doesn't support it till now.
That's a good point. For now, it doesn't. But I'm sure if folks in Wealthsimple are listening to this video, they will take notice, and I'm sure it is going to be offered at some point.
So, all right. So now let's dive into the two major advantages of CDRs.
That's right. So the two advantages, like we talked about earlier, is fractional trading and currency hedge. Fractional ownership. What does that really mean? What it means is making the US stocks or the big US stocks more accessible. For a Canadian investor to buy a single share in one of the 5 more popular companies listed on major US stock exchanges, you would need to have more than 9,000 Canadian dollars at today's rate. And this does not include additional fees and service charges. So the top 5 US companies are Alphabet, Amazon, Apple, Netflix, and Tesla. Of these, Alphabet, the parent company of Google, and Amazon is roughly about $3,000 US dollars a share. Apple is about $150 US dollars, and Netflix and Tesla are in the range of $500 to $600 US dollars per share. Now, CDRs makes it possible for Canadians to obtain fractional share investments in these US listed companies, as I spoke about. So instead of paying roughly about $3,000 US dollars a share for Amazon stock, you can now buy CDR, giving you a fractional ownership of a share for as little as 20 to 30 Canadian dollars.
All right, so now let's speak about the second major point associated with it, that is currency hedge. So we'll take the example of Apple, and let's just say that we bought $100 worth of Apple stocks. I know it trades at 150, but let's just assume that we bought Apple stocks for $100, and Apple stocks saw a phenomenal gain of 40%, and Apple stocks started trading at $140 US dollars. Now let's just assume that US dollars appreciates by 10% relative to the Canadian dollars. Now if you had invested $100 and it increased by 40%, then it would be $140. But we've added a layer of complexity, and that is USD to Canadian dollars. And now, because USD has appreciated by 10%, your 10% profit margin will actually be taken away, which means that your $140 will now become $140 minus 10%, which is $126. So therefore, if you are a Canadian investor, then instead of 40%, you would actually only be gaining 26% in this.
Yeah, that's a very good example to illustrate. Now, let's look at the flip side of it. What happens when Canadian dollar goes stronger to US dollars?
Yeah, so that also is an example. And I purposely chose the first one because it was showing that you lose out.
Right.
But let's talk about it. So if it gains if Canadian dollars is stronger by 10%, then on the flip side, you will gain 10% more. So your 140, Nitish, is going to become 154. So 140 plus 10%, which is 14, which is 154. So therefore, a Canadian investor in an Apple stock here would have gained 54% as opposed to a 40% actual growth in the stock value. So you see that there is a layer of complexity that is getting added to it, and that layer of complexity is the FX. As it is that the stock market is so uncertain, I'm not sure why anyone would add another layer of complexity to it.
Yeah. So the key thing we wanted to highlight here is that you could gain more due to currency fluctuation. You could also lose more due to currency fluctuations. The challenge is typically in boom markets, US currency is typically very strong, and more often a Canadian investor would lose value. Regardless, we wanted to convey that a CDR helps take out another factor of uncertainty, which is the FX rates, out of the equation when a Canadian investor invests in a US stock.
Now, to take out that FX risk, Nitish, there is a small price that we have to pay. Now, if you look at the terms and conditions of the CDRs, you'll actually see that you might have to pay up to a maximum of 60 basis points on an annualized basis to hedge the FX. Now, this paying for hedging is not anything new. Like, I'll give you an example. Vanguard, if you buy the VFB, you have to pay for hedging, but they're providing you a great service. So I think that it's a small drop in the ocean when you consider the benefits that it's giving you, like no issues with FX, it's allowing you to dollar cost average, it's allowing you to buy in small chunks. So I think it's a win-win situation.
Right. And that 60 basis points is a great point that Api mentioned, which equates to about approximately 0.6%. That's the maximum you would pay for this. You should also consider that the alternative of you as a Canadian investor investing in US stocks, you would convert the Canadian dollars to US dollars, and brokerages typically charges somewhere around 1 to 2% as an FX conversion fee. So there are two important concepts that we want to highlight in this video. One is the power of fractional trading, and the other is the importance of CDRs. Fractional trading, as we highlighted, allows you to buy a fraction of a share, and that allows you to dollar cost average on a more consistent and periodic basis. The other important concept or an instrument that we want to highlight is CDRs. CDRs, as we highlighted, allows you to buy fractions of a stock. So there is the advantage of fractional trading, and there is the advantage of FX hedge as well. With CDRs, by buying in fractions, you are also able to do dollar cost average on a more consistent and a periodic basis. So that's it, folks. Do let us know if you have had an opportunity to invest in one of the CDRs, and do let us know which is your most favorite CDR of the lot.
Thank you so much, and we will see you in the next video.
Thanks, everyone.